Good evening, everyone, and welcome to 4C Web Connect. In today's meeting, we have an amazing expert who will be giving us insights about a very interesting topic. But before we begin, let me introduce myself. I am Nishita from 4C Infinite, and let me tell you more about 4C Infinite and what we exactly do. So, 4C Infinite is a thriving online paid community established a year ago where business owners can collaborate, share knowledge, and support each other for exceptional business growth. What you can expect from this community is 4 online meetings, out of which 2 would be business meetings only for the paid members, and 1 is a Web Connect session that happens once in a month. This session is open to all paid and non-paid members. And the special part about Web Connect is that we have different speakers on board who give us insights about the trendy business topics, which is helpful in our business. What you can get from this community is a channel for connecting with like minded people who can support in your business. A channel which gives you a chance to learn the basic, intermediate, and advanced. And lastly, it's a channel which provides accountability, collaboration, growth, and success. Well, this is a subscription based community. So, to be a part of the community, you can scan the QR code or also click on the link from the chat box. I'll give you 30 seconds to scan the QR code if you're interested. Okay, well, this was all about how 4C Infinite works. And to get more updates, you can follow us on our social media handles, which are shown on the screen, or you can even feel free to get in touch with me. My contact details are definitely given on the screen. Moving next, let's go on to our knowledge segment, which is where we will introduce our speaker and the main agenda for today. Give me a second. Here we go. So, our topic for today is how to build an emergency fund. The main agenda behind this event is to create awareness about the new products or services in the market. And through these webinars, you can get a chance to connect to our experts and hence build a good relationship with them. Today's webinar is beneficial for those who are eager to strengthen their financial security by conquering emergency fund strategies. Before we proceed, we have a few house rules to be followed. All participants are strictly requested to be on mute. Spamming is strictly prohibited. If you have any queries, please put them in the chat box or you can raise your virtual hands. Now I'd like to introduce our speaker for today, Mr. Amit Sharma, who is also popularly known as Sharmaji. He is the founder and the CEO of Sharma Consultants, dealing in investments, insurance, and finance. He started off as an independent insurance consultant in 2018, and he has grown his company exponentially by qualifying as the youngest independent financial advisor. Being a people's person, Amit loves understanding his clients' behavior, their thought process, and life deeply to craft their finances with great accuracy. He also coaches young individuals to live an EMI-free lifestyle and have a passive income while they are young to enjoy their cash flow early. Well, Amit has also received multiple certificates and he has been a part of multiple workshops, which I really feel that Amit can introduce him by himself and tell us more about it in detail.
All right. Good evening, and first, good evening, everybody. And thank you so much, Nishita, for introducing me a bit in a very amazing way. And since you told me to introduce more about myself, hi, everybody. This is Amit Sharma. By qualification, I'm a software engineer from Mumbai University, and I used to work. My first company was Infosys. That was in 2011, and post then I worked with an IT company for let's say around about just 4 months. And after that, I've been self-employed from the last 12 years, you can say. And we started in the financial planning industry in the year 2018. Since then, we are a $1 million Roundtable Club qualifier, which is supposed to be the highest Oscar award in the financial industry. And above that, there's a Court of the Table award, which we've been qualifying successfully. And as of date, we've been working with more than 3,000 families worldwide in more than 16 countries of the world. And as a financial planning firm, we handle assets of 170 crores. Yes, to be very precise, we are handling the entire assets for all the clients that we are working with. We not only work with financial organizations and financial distribution products, but also we work with insurance primarily because that's how we started. And yes, I do participate in a lot of national level activities with respect to my work, that is financial planning. And I'm undergoing a QPFP, that's a qualified personal financial professional certification, which is undergoing currently. And yes, why I'm doing this, I'm very passionate about what I do. So you'll come to know in the next 30, 35 odd minutes about why I am here between all of y'all to share the best of my knowledge that I have. And we've been doing a couple of, you can just go to the next slide once. Possible. Yeah. I will put my screen on about the workshop. Is it on, Ishita?
Yes, your screen is visible.
Perfect. Sounds good. So these are some of the workshops that we've done in the last.
1 second, Amit. Sorry to cut you. If you can just make it full screen, please. It's easier to see.
Certainly.
Great. Thank you.
Perfect. Yes, these are certain workshops that I have done in the last 180 days. You can consider. That's why I've just given some of the bit because I've done more than 100 workshops in the last 6 years. So considering the time frame and the space given to me, I can mention a few of them. And before we start, I would be very happy if all of you all keep your videos on so I can see all happy faces in the, on a Friday evening, all of you all have invested your time. If you can keep your videos on, I'm certainly going to get some very fruitful knowledge to you in the next 40, 45 odd minutes. And I'm certain about it that this 45-minute workshop will actually enlighten you to understand your money depth. So before I go ahead with the next, what I do and how I do, can we request everybody to keep your videos on? Maximum participants can keep, even if 80% of you all keep, I'll be most happy. Okay, perfect. Yusuf is here. Hey, hi, good evening. All right. Perfect. Okay. So what I do basically, if you can see here, I'm empowering individuals for intergenerational wealth. Now, what do you mean by this? See, I started working at the age of 21. That's what most of the people start. Like I'm based in Mumbai. As an engineering graduate, I started working at the age of 21. And I saw my manager who was at that time 30. And there was a project manager who was 40. And the director of the company was 50, who was Narayan Murthy that, those days. And so on and so forth. So currently, if you see, what I'm doing is I'm empowering individuals individually and working on their intergenerational wealth. We used to work with the grandfather. Now we're working with the son and their grandchildren as well. How we are doing it and why we are doing it, that's the most important thing. See, we all have a limited period on this planet, right? And sure, we all have in a year 52 weeks. And if I just consider an average of 1,100 years, so we have like 5,000 weeks maximum is what we all live, maximum. And out of this, the first, let's consider the average of 80 years in our life. Agree? So 80 years, as in first 20 years, we don't do anything. We just work, we just play and fool around. Last 20 years of your life, from 60 to 80, what we do, we just expect to retire and enjoy our incomes. And in between the age group of 20 to 60 is what we all work. We all are dependent, right? We have a family and we all want to grow. But in this 40 years, I have seen maximum people, wherever I work with, I have seen they are not being very planned about their lifestyle in the first 40 years of their working around. Like, when you're working at the age of 21, nobody has taught you what to do with your money. Like I remember when I got my first salary being a software engineer, I have spent entire of my salary with everybody that was around me. I wanted to buy the best gifts for my family, and that's all we do. But guess what? Before I started, I saw this happening with most of my individuals. But I started my investment journey when I was at the age of 17 only. Yes, you're right. I started at the age of 17. And that's where, where I made my first internship money after graduate in my class 12. And that's where I started my investment journey and started investing. So why I am doing this very passionately is because when I see people doing the same financial mistakes and coming in their same, uh, you know, at the age of 35, they don't have a lot of money to buy their house. At the age of 45, 50, when their kids go to the abroad education or when they study globally, they do not have a lot of money to take care of their post graduation. So they need to basically take education loans. But I am of the view if you're financially well planned, if you're empowered by a financial advisor, if you're working with a doctor who's mastering his personal finance, then your life is pretty sorted. And I'll be glad to say I hit my first 7 crore rupees in my life when I was 29. I can say in INR, there are people from Dubai also. So Nishita would be a good person. Dividing it by 23, that's almost, 3 million, 4 million dirhams. By the time I was 29, I hit that. And that's why I can empower these individuals today at a global level also. So I would just go through in deep further that how we do and what we do. And I'll be very glad if in case any person in this audience is having any questions, just put keep yourself on unmute mode and just or else just type it. We'll take your question and answer at the end. All right. So I'll go ahead. Now, what do you expect from this next 40 minutes today? First thing is everybody wants to be wealthy, but nobody wants to know how. Second thing is how do we achieve this financial well-being? Doctors talk about a lot of health. I only talk about a lot of wealth because my point is if your finances are sorted, then only you can enjoy, right? Other people say if you're healthy, then you can enjoy your money. But I always say, even if you're healthy and you don't have a lot of money, what will you do? Correct? So today we'll understand what is financial well-being. Second thing is how do we achieve that? We have taken this in a short 4-step process and the action plan of how to do this. These are the 3 topics of what we're going to run through today. Let us first understand financial well-being means what. What is financial well-being? Okay, now financial well-being means, let's say an example, I see a lot of individuals here. Can somebody type what is their next financial goal or, financial goal of a 40-year-old individual? Oh, okay, can somebody put in the chat box? What's your financial goal in the next 5 years? Yusuf, can you type chat in the chat box? Or you can unmute yourself. Okay.
Chat. Oh, okay. Chat. All right.
Nishita, you can help me in reading the chats. Mega is writing to have a financially well-being and early retirement. Great. So Mega Magre has written early retirement. Mega, now you know what? Early retirement is something that we all love doing. I'm waiting for Yusuf's answer also. Yusuf about. I am waiting for your answer as well. Okay, to create Anupama ji has written to create a huge corpus. Okay. In the next 5 years, I hope to retire peacefully. Great. Amazing. Are you currently employed or self-employed?
Self-employed.
Amazing. So you have your own business. Now we all have a goal of getting retired early. Anupama ji said to have a good corpus. You said to retire peacefully. Now also we have to understand if you want to go to a marriage, if there's a marriage coming up in our family in the next 2 months or say 45 days or it's a big event, we all go for shopping so much planned. Correct? We all go for shopping so much planned. If you want to decide your car's color, you will ask your 10 family members and get it decided. You do your research and do it. But what about your financial goal? Have you undergone any training in that? Or are you consulting some person? You must do that. That's the most first important thing. I'm just trying to understand what is financial well-being to you. Second is, in that financial goal, we also have to remember that there will be some contingencies which may come, which we also have to ensure that these contingencies are taken care. Correct? So when we are taking care of these contingencies, like something happens to me in my retirement, if I'm ill, will my corpus be burnt or not? Yes, definitely will be burnt. So I need to have a critical illness and a major health insurance. And most important, when you're doing this thing, Mr. Yusuf, in the next 3 years or 4 years, you should be totally confident and have a satisfaction that currently what I'm doing is perfect. It's very, very, very important. This is something which I call as a holistic financial well-being. You need to understand if you're satisfied with what you're doing, the end result will be definitely a better one. So if you tell me to summarize what is financial well-being, A, having a goal, B, knowing what you're doing, that is again being at peace, and third important, protecting that goal. I want you to start protecting that goal, Yusuf, from today, that you need to protect your retirement, that you need to protect your corpus, that Mega, you need to protect your early retirement thing, and just get your distractions away, right? Because most of the times what happens is after this workshop, everybody goes like, I want to retire early, and tomorrow morning, you have a lot of money in your bank account, and there is some good offer that you're getting on your pre-owned car, and you go and buy your pre-owned car. Your goal is done. You're not sacrificing on your goal. So that's why it's called as protecting, right? Now, how do we do that? How do we do that? How do we understand what is financial well-being? So there are 3 steps. First is prioritize it. Second is plan. And third is review. It's called PPR in shortcut. PPR. Let's understand how to prioritize your financial health. Okay, so you all have a pen and paper, correct? I want you to write down what's your financial goal, what you told me. 2 financial goals in the next 5 years. Let's write 2 financial goals. One is what you've written. 2 financial goals. Ask me what's my financial goal. I want to have a very big corporate office in the next 3 years. That's my financial goals. Okay. And I am going to upgrade my car in the next, it's just completed 2.5 years. So more 2.5 years, I'll be upgrading my car 5 years from now. 2.5 years more. That's my second goal. And third goal is to have a golden visa with Dubai. That's my third financial goal. Yeah, so I include that goal as well because that requires money. Now, what do? I understand my first financial position. Where am I currently? So, preparing a financial plan. Now, I know that I have to have a car, I have to have an office, and I have to have a golden visa. Correct? Now, what I'll do is I have an income formula. I want all of you all to write it. It's called the thumb rule of financial plan. 30, 30, 40. Out of every 100% of what you earn, so first 30% should be your investments. The next 30% should be your EMIs. EMIs is mortgages. Any loans or liabilities. And the last 40% should be your expenses. It should be the same way as I told you. 30, 30, 40. The first 30% should be your savings. Next 30% should be your EMIs, and the last 40% should be your expenses. Now, why do you do that? It's very simple. When you're eating food as well, you have your salads, you have your juices, you have your vegetable, you have your breads, and everything included, and your pickles as well. You cannot only have roti, or you cannot have only your breads and tell that my stomach is full. Likewise, in your income also, there has to be some certain portion which has to go to your investment. That is 30%. For people who do not have any liabilities and loans, please start putting 50% aside. Do not have any liabilities or loans. Liabilities means only EMIs, bank EMIs. Start putting away 50%. Till date, I invest 52% of my income that I generate every month. And in this, I'll give you one more tip. What you should do is understanding your financial situation means after understanding this, you should also remember it is not income minus expenses is equal to savings. It should be reversed. It should be income minus savings is equal to expenses and EMI. As soon as your business profit comes, Mr. Yusuf, start putting aside 30% of your income right from your salary check day. If your salary as a director, you're withdrawing on the 1st of Feb, put aside 30% for you as a business profit, 10% of your net profit. Put aside. See, your business can go up and down, but for you or your family, they cannot go up and down. Correct? These are the two thumb rules which I gave you for understanding your financial position. All these things we do in a deep consulting when we do a one-to-one consulting with any family that we work with. All these things are extensively covered. Now I come to the second point, contingencies. There are three kinds of contingencies that may happen. I may get ill, I may fall, I may trip, I may get a fracture, or something happens to me and tomorrow morning I don't get up. All these three contingencies should be taken care by a good income protection, by a good health insurance, and by a good critical illness rider. Next thing is, after doing these two things and after understanding what's your goal, you should start jotting down your goal. How much money would you need for each goal? So coming back to you, same. First was Mega. Mega, you told me you want to retire early. How much money do you need for retiring in India? If she is not there, then Yusuf, somebody can. Yeah.
Well, usually I will retire in Jordan, actually, not in India.
No problem.
So,
I know you're.
yeah, so I would probably need about, let's say, 800,000 Jordan dinar, which is about $1 million.
$1 million?
Yeah.
Okay, that's a very good money. So
Yeah.
what you have to do is currently you have to plan your future goals also, correct? And also you have to have your current 40% of expenses. What you should start doing is whatever is your net worth as of today, if you want to accumulate 1 million your Jordan dirhams, start putting aside how much have you already made,
Mhm.
which you will never touch again unless and until it's an emergency. I'll teach you how to, create your emergency fund. That's the main topic today. But also, apart from that, whatever is spending, start working on that. And how to do that? That's the next part. What are the instruments to be used? That's the next part. So basically, let's say example, I need 1 million. I have achieved 30% of it, or I have achieved 70%. I need 30%. So I should start assessing my situation for the next 30% of what I'm doing. All these things I started doing when I was at the age of 17. My parents taught me this. That's why I could easily hit my retirement at the age of 29 only. And I'm on passive income for the last 6 years. I get up in the morning not to go to work to earn anymore. I only get up in the morning to empower, and the team that I have to ensure that they also grow along with me and my business grows. Next thing is, most important, be at peace about your finances, which I'll explain you how do we do that. Next thing is review individuals. Let's look at some data. Okay. Now, understanding the goals, that's the third part. Planning your goals and the future. Now, when we are planning our goals, as I told you, we have to assess the situation. What are the instruments that we should use for creating retirement funds? So there are two products available globally. One is equity and one is debt, which I'm sure everybody on this platform knows about. Ensure that your equity proportion is only that much where you can take risk factor. And I'm sure Anupama ji has introduced me to, there are a lot of entrepreneurs here on the group. Every entrepreneur gets up in the morning every day for taking risk. So you're already a person. Let me congratulate you that you take risk every single day of your life. So don't worry. If your money is volatile in equity, it may not go up and down. It may go up and down, but you'll never lose your capital in your equity. I'm talking about mutual funds. I'm not talking about direct stocks. So try having your goals. That percentage should be very simple. It should be as per your age. So if I am 35, I should be having 35% of my guaranteed money and 65% of your money to variable. That's 100 minus my age. 100 minus my age should be is equal to debt, and later on the part should be to equity. So 65% into equity, 35% to guaranteed and fixed income plans. This is how I'll plan for my goals currently and future. And also in this, I'll consider a simple factor, that is inflation.
Could you repeat that, please? That age
Sure.
100 month. Can you please repeat?
Yeah. Gauriji, may I give you an example? Let's say example, I'm 35. 100 minus 35 is equal to 65. 65% of my money will go into equity. 35% of my money will go into guaranteed saving products. Because I know when I retire, or when I want to get my son, when I want to get my son married, or when I want him to study abroad for any education, I will certainly need some money guaranteed. Because life, we all work on guarantees. We not work on variables. So guarantee has to be strong. So 35% guaranteed, 65% variable. Variable means SIPs and mutual funds. And stocks if your risk appetite is more. And stocks only if you have a person who does research for you, or you are involved in so much of research, then only go into direct stocks. I hope I answered your question. Okay.
Yes.
Now let's talk about something. How do we review? And let's talk about the same thing. That when I spoke to you again about the car, office, and the visa, the goal. Now what I'll do is I will be every month very much disciplined when I'm talking about my goal. If I want to take that 30% off from my income every month, I will certainly take it off every month and then only use my other income. But let me tell you, across the world, across the globe, the indicator says that only and only 28% people are financially literate about these situations. The rest of the people do not care about the money. They just earn, they spend. That's why they have to retire till the age of 65. I mean, after the age of 65, because nobody talks to them about these things. But when you take your 30% aside, when you take your 40% aside, I always say people, what you're doing? You're asking so many days from your, I can say in a better way, you're asking from the nature so many days not to work in life. So let me tell you, I started my investment journey at the age of 17. I used to put aside a lot of money because I knew someday I would become 30 and someday my lifestyle expenses will keep on going high. So I ensure that much money, if I keep it aside every month and every year, I'm planning for my future as well, not only for my current expense. So that's how I'm just in general talking about how do we plan for your goals and how do we plan for your current goals and future. I see, considering the time factor that we are in, I cannot give you a lot of details because, when we do consultings with individuals that I work with, there's a 2-hour one-to-one call that we do. We understand all the parameters of the budgeting, expenses and everything. And then only we decide what are the products that we should offer you for taking care of your goals. And once you're doing that, we do a regular review. So I review my portfolio every 180 days. That's every 6 months, which actually gets me a lot of peace of mind and gives me a lot of confidence that where my money is going every day. Yeah, that is what you see when you see your portfolio, when you get up in the morning and you see your portfolio, that shows you, oh wow, I can retire today morning also, or I can retire 5 years from now, or I can have my son's or children's education's goal, or I can buy a car. But if it's not there, that forces you to work till the age of 65, and that forces you to work. That working should be there, but it should be passionate. You should enjoy doing your work, not do it because you have a pressure of load of your goals and EMIs. That's the most important thing. And you can only do that once you have a dedicated individual, once you understand, you get a lot of confidence, automatically you're at peace with your finances also. Now, let us talk about, some of the mistakes that, individuals do usually when they are doing with investing. See, we all love doing SIPs. These are the new, it's a new thing. Everybody wants to invest in a country like India, and everybody does SIPs. A lot of people do SIPs. And, when the markets go up, they remove their money. When the market falls, they stop doing their SIPs. But that's the, only thing. If you see the data that shows that only in women and men. Not the average is only 15%. Only 15% of people on this planet globally are dedicated to their investments. I told you 85% are not. This is global data by Economic Times Money. The source is also given. Means if you are trying to tell that I'm going to start making, say, I'm going to start investing 500 grams or 2000 grams or 3000 grams or, 5,000 rupees or 50,000 rupees a month, guess what happens? You are dedication is there or not? It only depends on how strong your goal is. So the data shows only 15% average you see here is a dedicated and committed investor. Second thing, look at the number of SIPs that gets terminated by the investors. Now this data is 2021. The latest data also tells that why I have shown you from 20 to 21, there is a reason. Because in 2021, the global economy was hit by pandemic. After pandemic, everybody started knowing what is investment because they saw post-retirement. But let me tell you, before that also, averagely, 20% of the people, it shows that they stopped their SIPs in the first 1 year or 2 years. But AMFI data in India shows that 96% of people, which is now substantially reduced, it has gone to 84% of people stop their investments when the market falls because they do not have a dedicated professional who guides them with their investments. So do not do that mistake. Be more patient. Third thing is take compliance more seriously. 30% just round the corner. See, still we have 68% men who filed tax returns in the last 1 week. Take your tax returns more seriously. Women are 32%. So this is the data that is shown by ClearTax. We cannot take compliances very casually when it comes to tax filing in any country or when it comes to investments. So the thumb rule, which I always say is, once you start investing, please write this line down. Once you start investing, you should only stop when your goal is achieved. Ask me, till date, by God's grace, I've never stopped any of the investment plan which I've started. I ensure I'll fuel that investment plan month on month basis and I'll only start how much I can easily do per month. And second thing is, after your income grows, never take your increased income home. I see a lot of investors doing that mistake. If my salary was, say, 5,000 grams, or, let's say, example, if my monthly income is 20,000 grams, or if my monthly income is, say, 5 lakh rupees a month, what I'll start doing is, I'll start actually spending that amount of money. But I'll tell you, friends, what you should do. You should also remember, when tomorrow you want to retire, this 5 lakh thing will also become 7 lakh. It will keep on growing. So ensure that every money that you're earning in yearly basis, kindly top up your investments. Don't keep the same. Second rule. First rule is start your investments and achieve it till the time you achieve your goals. Do not stop it. Second is, as I told you, increment it year on year. If you do not do that, then guess what? At the end of the day, you will always have a situation where what you need and what you have there'll always be a lag. So let's say example, what are we, understanding from this? That men are better investors, but actually women on this planet are more disciplined and they stick to their plan rather than approaching like investment, like trading, because they do not have trading knowledge. Perception is women withdraw money sooner and are less confident. No, it's not like that. The reality is not being overconfident leads to women being more patient in volatile markets. Because I have found when it is taught to some women, they understand it well and they keep it for a very long time because they understand the logic very well. And women are perception is they are seeking, less help from professionals. But let me tell you, in today's world, 29% of females of the world have financial advisors and they are working with a dedicated professional. We approximately work with close to 1100, 1200 females all across the world. Yes, and that varies from the age group of 18 from doing people who are doing internships till the age group of 75, 80 also, who are already enjoying their retirement. Yes, absolutely. Okay, so let's understand now the second part. I'm going to this part like where we started. We started with this. What is understanding financial well-being? We have understood what is financial well-being. Now let us also try to take the second part. How do we achieve this? How do we achieve the financial well-being? Because there are some action steps that how we can achieve that. So I'll be showing you how do we achieve that as well. First thing is 7 steps. First step is make a budget. Now, what is budget? What does your budget mean? I'll stick to the same thumb rule which I told you already. The thumb rule is simple that you need to have 30% of your expense into EMI, 40% of your expense into your house expense and your personal expense, and last 30% should be your dedicated investment. So it's 30, 30, and 40. It should be 30% savings, 30% EMI, 40% this thing. Let us talk about the 40%. This should include all your grocery budgets. This should include all your electricity bills, your gas bill. It should include all your daily necessities like your rentals, your electricity bill, your Wi-Fi bills, everything it should be included. And also it should include your medical bills. It should include your health insurance. It should include your term insurance bills. All this thing is your regular monthly expense. If you are part of any community, if you're part of any networking community or you go to some clubs, that should be counted in your monthly expense. Second thing comes our personal expense, that's variable. We all like shopping. We all like going out vacations. That should be a variable expense. And also there should be a maintenance expense. You should categorize your expenses like that. They should not cross 40% of what you earn. I see a lot of people doing this mistake. I'm earning 100 and I'm spending 68% of half 100. Guess what? Definitely we will all have an issue when we are all turning old because inflation is there and we will not have an active income that time. So think about it. Your active income also has to exist then. Right? Next thing. Let's say this was something. Let's talk about more about emergency fund, which is our main topic. All of us, we like to go to vacation. All of us, we want to take a break. All of us also have certain commitments which are unlikely. It can happen anytime. So please start creating an emergency fund. I like to call this fund as a reserve fund. We all have a reserve stepney, a stepney in our tire in our car. We all have some reserve fuel in our cars, which shows an indicator on the last blink. So why not have a emergency or reserve fund? Your reserve fund should be equal to 1 year of your expenses per month. So if your expenses are, let's say, an example, 5,000 dirhams, 10,000 dirhams, or in India, if I say if an average expense is 100,000 a month, please first start building your 12 lakh rupees or start building your 60,000 dirhams and keep it safe. Where you will keep it? Not in the bank. Start keeping it in liquid funds in the mutual fund. Should not keep this money in the bank. Bank will not provide you a lot of interest. Use liquid funds. There are a lot of good liquid funds which we recommend. We can keep there or have a fixed deposit, which is easily liquidable like an ATM card. You go to a bank and you withdraw it. Don't think on this money interest kitna milega. Do not think about what's going to be my interest. Everything is life. In life is not interest. There has to be something which has to be guaranteed. Corey, do you have anything? You can.
Yeah, what did you say liquid funds are?
Mutual funds. Mutual funds are liquid funds. These are overnight funds. Unlikely, these funds will not participate into equity market and they are not volatile. Your money doesn't go up and down. This will give you 5 to 6% annualized return yearly basis, and 6% is decent. Are you from India or from Dubai?
I live in Dubai, but of course, we all have base in India. Yeah.
Perfect, cool. Still, a lot of individuals in Dubai who work with me, they all do their liquid funds. I'll tell you, y'all make your rental income there and y'all invest in India so that we make your retirement income from there and repatriate into the NRE accounts. So have liquid funds that will give you better, because NRE accounts will not give you more than 4.5 or 5. Right? Let's go to the next part. Why does your how to protect against this? First is your 12 months income is done, and medical expense. Let me tell you, your medical expense should be bare minimum, and it's, it should be bare minimum. I'll tell you how much. Yesterday I was working with a family from they were from Dera, and their insurance I did for 1 crore. That's approximately income, approximately there. It was like, close to 500,000 dirhams, which was decent. So have that much health insurance at least, and get a cashless card. So your country, anyways, cashless is the best facility. In India also, I would say base of 5 lakh and 1 crore top up. Base of 5 lakh and 1 crore top up. And please always also remember, if you are an NRI, if you come to India once a year, just check whether it's a global insurance or not, whether that insurance is valid in India. If not, I would insist you have a small insurance of 50 lakh here. Get treated in the finest hospital. It will cost you peanut, not even your airline ticket is that much is the basic cost for getting an insurance here in India. But have it as a backup. Do not only rely on an insurance in your country. Even if you come 15 days in a year, still I would recommend. Like all the NRIs that I work with, they all have a backup insurance in India with us, where they have in their own country, but here also they have. Because you never know after 15 years from there, what's going to be the situation, whether you want to come here back in here in your country or not. Your wish changes, your desire changes, whether you want to settle here or not. But if you have, it's a dual airbag protection. One from the primary country, one from your secondary country. And most important, your insurance also has to be there. What is the insurance thumb rule? First, you should have 15 times of your annual income as your term plan. 15 times of your annual income should be the term plan. Now, what does the term plan basically mean? Tomorrow, if I am not available on this planet, will my family be able to sustain next 25 years of the same lifestyle without selling their assets? I repeat, you should have 15 times of your annual income. Second, will my family be able to sustain 25 years with the same lifestyle without selling any assets? Most important, whether you need a term insurance or not. If your 25 years income, so let's say an example, if you have, say, 1 million dirhams in gold or in properties or in something wherein the rental itself is equal to this of your monthly expenses for the next 25 years, do not buy a term plan. It's waste of money. Please do not invest in term plan. If you already have assets created, term plan is only for those individuals who have more liabilities and lesser assets. I hope this point is clear. Health insurance is a need for the family. Every smallest, tiniest individual to your family, from the youngest to the eldest, please make sure that you all are protected. And yes, critical illness and personal accident is very, very, very important. Even if you trip down, if you have a small fracture, you should get your 4 weeks or 5 weeks of your income, which should be there. It should not be, you're helter skelter or you're not there with your personal accident. Please ensure that your loss of income is also taken care. Critical illness is the most important thing. If I get struck with cancer or kidney failure or anything, I should be taken care sufficiently to my family's lifestyle should not come down. So let me tell you, this all comes in your 40% of your expenses. Lifestyle, family, vacation, everything 40% is zyada nahi karna hai. So we covered the first point, that's budget. Second was risk. Now let's talk about inflation. Your inflation is always there as a catalyst, which will always eat up your investment if they are not very well. A lot of people put a lot of money into low yielding instruments which are giving you 5, 6, 7% always. But let me tell you, you remember that thumb rule formula which I gave you, 100 minus your age should be equity. Ensure that that much is in equity. 2,000 rupees, and this is an Indian standard. 28 rupees was the petrol price. 2020 is 80. 2024 is 106, 104. That's the average. gas is at 88 rupees per liter. That's almost 4 dirhams. That's the average, correct? What will happen in 2030? Let me tell you an average standard of India and your country. It will be 6%. In your country, developed countries, the inflation will be 3 to 4%. In India, in the next 15 years, will be 6%. Anything that is giving you above 6%, please buy that service. Please buy that product. It will be very good for you. Inflation also has to be kept for sure. If today you're having a capacity, like, most of the families that I work with in Dubai, they all have an expense of around 25,000 dirhams per month. That's the bare minimum expense. So when we design the retirement plan, say after 10 years, we ensure that the 25,000 will become 37,500. So we design a plan in such a way that this person gets 40,000 dirhams per month for the rest of their life, even if he stops working. So Walid bhai, you are into real estate. I know you very well. Walid ji, you have to also ensure that the houses that your real estate consulting prices, that you're consulting to people also, but ensure that you also have a retirement plan into place so that tomorrow at the age of 65, when you are needing, you would want to stop working, you need to have at least 25 to 35,000 dirhams per month for taking care of your life and do what you like doing. Right? So that is inflation. I'm just mentioning some few people because this trip I have met these individuals. I know them in person. That's why I'm talking about them from their pictures that they have put. I'm just trying to take their names. Now let's talk about value of money, which we have already spoken about. That if your money is growing with 6% every year, in the next 12 years your money will get doubled. Let's say an example. If today you need averagely all these expenses, fine dining 5,000 per month, Apple iPhone 1 lakh, sedan car 8 lakhs. There's no sedan car that comes in 8 lakhs for sure. Offline, online cap 10,000, 3 BHK, and luxury vacations and all. If you need, guess what? After 10 years, you need to check. In the thumb rule is 72 divided by 6. In the next 12 years, all this will get doubled up. Are your investments that much sound that even if you stop working, your investment will deliver this? If not, then there is a checkpoint. You need to sit with your advisor and start working on that and start making strategies how we can achieve that deficit. If it's no deficit, then you're doing wonderful. Then you can probably just continue what you're doing. But ensure that I have never seen people with no deficits till date. Because always there's deficit. The reason why? Because when our income rises, our expenses go on a higher scale. We try going out and partying in the best clubs. We try going out and go for wine dine in better restaurants. But our investments are still that small. So ensure that, please ensure that inflation is also taken into account. Okay, this is all taken care. Diversifying your investments is very important. Yes, these are the four asset classes. One is guaranteed. Second is gold, third is real estate, and fourth is equity. These are the 4 ways of all the 4 sources. I call it as pockets. You should have money in all these 4 pockets. You see my 4 fingers and 2 fingers have gold. And 2 fingers there is no gold ring. Why? Logic, again the same thing. Diversify your investments. Put some money into debt. Put some money into gold. Put some money into buying a house and yielding a real estate return. And put some money into equity. It's the most important thing. That's how you will hedge your risk and hedge your inflation. Right? Okay. Let's talk about the next part. That is risk versus returns. See, sometimes what we say is returns zyada hai to risk kam rahega. No, it's never like that. Higher the risk, higher the return. You want to have, what are the instruments? 6% debt, 10% gold, 12% SIP, 15% mutual funds, that is lump sums, 25% stock market, Bitcoin. So higher the risk, higher the return. But remember, you can only take that much risk, which is as per your appetite. Do not go out and take more risk as well. So ensure that your returns and your risk reward ratio is known to you. If you don't know how to do that, ensure you sit down with an individual financial planner, go through your all financial goals, then only take risk. I come across with a lot of people who tell me, I want to invest in this, I want to invest in that. This sounds very appealing. Because most of our investment decisions, friends, are guided by, I'll tell you whom, are guided by either your colleagues, either your weekend party friends, either your hoardings or banners, or either your parents or your loved ones. Correct? But what happens is, are they experienced? Have they already achieved that? And if they were pro in that, they would have done their qualifications in that. But the point is very simple. When you're ill, you go to a doctor. If I want to do a cardiac surgery, I will not go on YouTube. I'll go to a cardiologist. Likewise, it's a simple thing that ensuring the risk reward ratio is very important, keeping you as an investor in mind. That's very, very, very important. And knowing your right asset allocation, yes, these are the investments of what you should do. That is FDs, debt mutual funds, equities, equity cash. If you want these slides, I'll share it with you individually. You can mail me or message me or ask Nishita. We can provide you them as well. And real estate and gold, which I've already spoken about. Now let's talk about goal-based investing. I am pretty sure that there are somewhere about, on this forum, we are close to the number of people that we have. We all have these goals of, buying a house, upgrading our cars, my daughter's marriage. I want to keep going to vacations. I want to do my master's degree for my children. And after that, doing everything, I want to take it easy and retire. But guess what? But for a marriage, we will have more planning. But I've seen people with all these things. Again, as I told you, maybe some of you all are doing it. As I told you, the index says, of the global index says that close to 75% people are not planned accurately. Only 25% people are there. Maybe if you're in the 25%, I must congratulate you. But if you're not, start thinking over it. Because these goals are going to be definite goals in your life. And you definitely need to have a plan. So make your plans as smart. I don't have to tell you what's a smart plan. We all have learned from our schools and colleges. Let's talk straight about SIPs. Why do you think SIP is important? It's simple. It's basically to invest 15,000 rupees a month. You know how much it will become in 10 years? At 12% average, you have 40 years, 18 crores. And 18 crores is good money. That's approximately equal to, if I just say 18 crores, divide by, it's close to 78 million. That's good money. Yeah, 1 million, that's 78 lakhs, 28,000. That's 7 million. My bad. It's 7 million in 40 years. Even if as a first generation, I feel I have not done anything, still if I just keep my SIP on for how much? 15,000 divided by 23, it's 650 dirhams. I will have my next generation as EMI free, and my next generation will retire rich and will start rich as well. So it's very, very, very important. Next thing is the power of compounding, which all of you all know. It's a snowball effect. If I keep my money invested for a longer time, then what happens? That this money starts getting compounded. This money starts getting compounded in such a way that I am buying units at every market fall. So if market is falling, I'll be happy because I'll get more units. If market is growing higher, I'll be okay. And I'm not so happy because the units will be lesser. But the more compounding effect happens only when I keep money after the first 10 years. So stay invested throughout the course till your goal is there. So the best thing is stay invested for 40 years, make your next generation rich. And that's basically the compounding. I've already spoken about these things. We can discuss in length in detail the one-to-one if anybody needs. And most important, make sure finances tax efficient also. Now, why is it important to be tax efficient? You don't stay in a country, Dubai, because you all don't stay in a country where it's taxed, but also there's VAT, which is just started. Start working on something. If in case you all have incomes in India, ensure that these incomes are also, you're creating is tax free. So what we do is we start creating your tax free incomes here and we repatriate when you need your money there. So ensure your taxes are also taken into place. Ensure that you're, having such products which are giving you guaranteed returns and which are tax free for all your life. Like in the last 25 days back when I was there, most of the families that I work with, I created a retirement investment income there. So by the time they're reaching the age of 60 or 61, they get 20,000 dirhams tax free per month for the rest of the life to take care of themselves. And I have surveyed that's the average income which is needed for running a family of two adults, one child or two child, bare minimum. Obviously, there's no limit, but this should be tax efficient also. And last but not the least, I want all of you all to learn one thing: be involved in your family finances. Like in my family, who's in charge of the financial matters? All of us. All of us we discuss. My wife, me, my parents, we all discuss at the dinner tables, at the breakfast hall time. We all discuss about our financial matters. Like my team, which is there in my office, we all discuss financial matters. We try to encourage financial talks always because we all get up in the morning, we go to work, we go to our businesses for only one thing, that's vitamin M. And vitamin N is everything that revolves around your life as well, whether it's your current situation or it's your future situation. So ensure that everything is being taken care. And for that, what I have done is I have a documented kit which I can provide you all as well. It's called FIDOC, FIDOK, which is Financial Information Documents Organizer Kit. I made a special kit for 4C Infinite community, which I would like to give a freebie to all of y'all who are attending my workshop. When if y'all need this, then in this family organizer kit, you will be ensured everything is taken into account, whether it's your health insurance, whether it's your life, whether it's your mutual funds, ABC, anything. You open this Excel sheet and you're taken care. I call it like a kundli. In Hindi, we call it like kundli pe sab likha rehta hai. Although I don't believe in that, but this is your financial kundli, which your family people should have. And friends, let me tell you, I created my first will in my life when I was 29. People get scared to talk about wills. My will kyun banao? I'm not too old. I made my will at the age of 29. Yes, you're right. So what happens when you're there? You're dead sure. You're so confident. If tomorrow morning you're not there, the will goes, the lawyer comes, and he takes care of the entire wealth. These things have to be spoken on the dinner table. That's why I told you who's in charge of your family matters. Ensure that all of you all are. That's why when we in our discussions we do financial planning, we encourage all the family members to be part of our conversations. Only the earning members I'm talking about, people who earn in the family. And the non-earning members, if they are 12 and above, I do monthly webinars for them. Like what I'm doing for your community, we do monthly webinars. These webinars, when they do, they actually empower. So I do 12 webinars throughout the year for all our investors. Every week, one Sunday, which is fixed, morning 11 to 12 IST. We do that. And all such information we give it. And I'm very glad when I see people more empowered, it just makes me, feel very good about it. So friends, it's time to take action. These were the small steps which I told you. Very efficient step. First is budget. Second is this. Third is protection. Fourth is diversify. Goal investing. Tax efficient returns. And last but not the least, be involved in your family finances. It's very, very, very important to know that, design your future in such a place in every aspect and then make a plan to achieve it with SC. That's Sharma Consulting. That's our company name to achieve it. So design your financial plan. It's very, very, very important to design a financial plan. Now, why it is important is simple that, when you're having these kind of plans, it gives you a lot of confidence. It gives you a lot of sense of security. Like I'm pretty sure Nishita has been, listening to me the second time, the first time we spoke at our office when Anupama ji had given me this opportunity. Nishita, a fair feedback. Did you know all these things already? Or be honest.
Honestly, I did not know, very bluntly speaking. I just knew a few terms in terms of investment that, yeah, you're supposed to invest money for the future. And coming from the young generation, I know that it's very important. But a few terminologies which you shared today was completely new for me. So, like, glad to gain that knowledge.
Good. And when I see young individuals getting more empowered, actually makes me feel very confident. You know why? Because I'm empowering somebody with a knowledge which was not taught to me in school or college, which was taught to me by my surroundings of my parents, friends, and relatives. So let me tell you, friends, the knowledge which I'm giving you, I pay a bomb fees for getting all this knowledge year on year. from the industry. I attend a lot of conferences. I attend a lot of workshops. I pay a lot of heavy fees to attend this knowledge, do my certifications, and then I come up to it's like your doctor is through for for their 7 years of studies, and then they do their small surgery, and you're all fine and fit and healthy. So it's absolutely very important. And that's why, we are in talks of registering our office in Dubai as well in the near future for exclusively for NRIs. So that we come there, we keep regularly working. Although my trips are 4 to 5 times a year in Dubai, but still, I would be very glad if in case I could be of very good assistance to y'all. And this talk of whatever was given to me, the specified time, I could empower y'all in that short span of time as well. And it actually makes me feel very happy. When I spoke to Anupama ji for the first time, she immediately told my community needs such kind of talks on a regular basis, right? And although she also wanted a bit of solution in her related to something else, that was her personal finance. When she approached me, I'm pretty sure she found us to be apt enough with her solution to give the solutions. That's why she engaged us in a talk with y'all as well.